Let's check on oil prices right now. We have seen them edging higher, making up for some of the declines from last week and rising 3% yesterday, actually. This all coming after OPEC stuck to its demand forecast. Joining us now, Bob Iaccino, co-founder and chief market strategist at Path Trading Partners and co-portfolio manager, the stock think tank. Thanks for so much for being here, Bob. So as we look at oil prices and as we saw OPEC sticking to its guns here, sort of contextualize this for us. What's the significance of them not changing the forecast?
Well, first of all, Prince Abdulaziz said a couple of days ago when the market started to head a little bit higher off of this and then turn back lower that give it a few days, the market will get what they were trying to say. And it seems to me what they were trying to say was, yeah, we're willing to get rid of the voluntary production cuts, in part because those production cuts are voluntary anyway. And a lot of these countries, specifically Iraq and some of the African producing nations, weren't really sticking to the voluntary section of the production cuts. But they didn't say they would do it. You know, a lot of oil analysts were saying this is the first sort of indication we've seen of more production, and prices went lower. But what we're seeing on the other side of it is the demand side might be a little shaky in terms of the sort of level demand that we've had lately. The summer driving season seems to be getting off to a pretty good start. You're seeing that in the consumer data as well as a little bit of the travel data. And also we have jet fuel shortages starting in Japan. And if they were to get more jet fuel made, that would be taking crude oil away from other distillates, which means they need more crude oil, at least going into Japan. Not a giant part of sort of supply absorption, but it would matter. They'd either have to export more or disappoint the market, which would increase the price of travel by air and increase the usage of people's cars for travel during this summer driving season. There's a lot of moving parts here, but I think probably the most important one, Julie, to be honest, is the U.S. rig counts, which have been going down basically since February of 2022. And this past Friday, we got the lowest number since January of 2022. That's not really a good sign for supply.
So, Bob, bottom line for you then, I'm looking at oil here, it's trading just under 78. Where do you think we are, Bob, in 3 months from now, 6 months from now?
Well, that's a tough question, Josh, and I'll tell you why. We've been in a downward sloping channel that you can see on the chart you just put up since about April. Let's call it mid-April. And we haven't broken out in either direction. And the thing is, when you stay inside these channels, even if you continue to respect the upper and lower bounds of the channel, price heads lower. The market tried to break out a little bit a few days ago and actually did end up closing above the upper side of that channel, but then broke back into it, reached down to the bottom, and now we're back up toward the top of it. Even if we break out now, we're about $3 lower than the breakout from a few days ago, and there's still some significant problems getting through to the upside. So if you ask me 6 months from now, we're probably a little bit higher in crude oil. Remember, we still, in theory, need to refill the SPR. So that puts a little bit of a floor in it. But it's tough to say because it's very economically dependent in terms of the data. Does the data get better? Does it continue to get stronger in the US and have that leak all over the globe? Or does it just kind of stay stagnant and the Fed doesn't have to do anything? That would basically mean slightly lower prices.
Well, I want to ask you specifically about the read-through to gasoline prices as well, because AAA, put the national average at $3.44 as of Monday, which is down the biggest actually week-over-week drop that we've seen thus far this year. Does that last for the summer, that we continue to see some relief on gasoline prices?
Probably not, because obviously with the crude oil, I don't want to call it a glut. We're oversupplied. You could tell that in the price. All right, that's something that's very good about people who are actively investing in crude oil, is it is a pure supply and demand market. It really is. You don't have to worry about CEO scandals or gap earnings or any of that. It's how much oil is out there and how much oil are people buying? What's the demand like? And right now, the supply has been exceeding the demand despite the OPEC cuts. And those OPEC cuts are almost 2 years old now, and they're remaining in place. So I would say that it probably doesn't last through the summer because there's a lot of moving parts, like I mentioned. Airline travel may spike up a little bit, and you could get, of course, geopolitical surprises. So if you ask me by the end of summer, I'd say we're probably a little bit higher at the pump than we are right now.
Bob, always appreciate you taking the time to chat. Thank you so much.
Good to see you.